You cannot create money out of thin air. Or can you? Let's have a closer look at the probably least known form of money: commercial bank money. In this video, we will explain how commercial banks are constantly creating and destroying money with the help of a process called fractional reserve banking. We'll also show you how this process affects you, even if you have neither a credit nor interact with a bank directly. In a nutshell, commercial bank money refers to loans or credit, basically debt, created by the banks using the already existing deposits. But how can loans be a type of money? Here it's where fractional reserve banking comes into play. Fractional reserve banking is a process in which a bank is allowed to keep only a fraction of its belongings into its vaults. This fraction might vary based on the monetary policies each country has in place and is typically between 3 and 10%. In our video, we will use 10% for simplification. This may sound complicated or even rightly illegal, but actually isn't. We'll further have a look at what exactly is happening behind closed doors after someone makes a deposit. Let's meet Bob. Bob recently earned €1,000 and knows the purchasing power decreases over time, so keeping much cash around is not a good idea. Therefore, he decides to deposit his €1,000 at a commercial bank that promises him a 5% yearly interest. The bank is happily accepting his deposit and assures him that his money is safely stored. Until this moment, nothing really changed with the money supply itself. Let's now meet Alice. She dreams about a brand new smartphone that costs €900. But since she doesn't have this money, she goes to a commercial bank and asks for a loan. Here is where the magic starts to happen. Fractional reserve banking enables the bank to keep only 10% of Bob's deposit and lends out the €900 to Alice with a 10% yearly interest. Alice goes and buys the new smartphone from Bob and pays him €900 in cash. Bob goes to the bank again and deposits his newly earned €900. Now, let's see what really happened. Although we only had €1,000 in a physical cash form, now there are 1,900 in circulation, €1,000 in the bank's vault, plus Alice's liability to pay back €900. The process can continue. The bank keeps 10% out of the €900 and lends out $810, and so on. As a result, the total amount of money in circulation, also known as the monetary supply, is drastically increased, as it contains now both the initial cash money and the newly created loans. There's something very important to be noticed here. While the purchasing power of the involved persons increased, the one of an independent observer actually decreased. We took 10% as the value of the fraction needed to be kept by the bank, but this is only the minimum requirement imposed by the central banks to the commercial banks. This percent is variable in the real market, with the bank keeping 10% in a strong market and increasing it in a time of recession when the economy is weak. This is caused by several factors. During a recession, the likelihood of someone to withdraw money increases, so bigger reserves must be available. At the same time, the likelihood of a loan to be repaid decreases, therefore the bank prefers to refrain from lending out. Since deposits create loans, the bank won't lend out, and it has also to decrease the amount of money deposited. Storing cash is not a viable option, as they have to pay interest on it, beat the inflation, and there are also the running costs of keeping the money safe. Deposits are decreased by reducing the yearly interest rate offered to the customers. Bob received in our previous example a 5% yearly interest. In less prosperous times, he might have got 1%, or even a negative interest rate, and such scenarios discourage people to deposit. But what keeps banks from failing? What happens if Bob and most of the other customers want to withdraw their deposited money at the same time? The first line of defense is that banks must have the money insured by an external institution. This happens, however, only up to a certain amount stipulated in the lending contract. For Europe, this is usually €100,000. The second line of defense is the capital requirements for the bank. Simply put, it's the amount of money from profit that must be held relative to the loaned out money before paying out the stakeholders. If both these measures failed, the bank will face bankruptcy. There is still a chance for the customers to be able to retrieve their money if the bank is purchased by another one which expands its operations. The new bank is obliged to take over the liabilities from the bankrupted bank, which includes the money that has to be repaid. So, is fractional reserving good or bad? Well, it's complicated. It's not a problem until it is. It's on one hand stimulating the economy by increasing liquidity in the market, which means more products to be bought and more jobs to produce them. On the other hand, it creates bubbles through this artificial increase of the monetary supply. While more liquidity will increase the price of assets, for example the one of real estate, it's bad for the people who are relying only on cash, as their purchasing power will only go down. The key takeaways from this video are: the current monetary system is actually based on a complex relationship between deposits and debt and not on real money. This is possible because people trust both banks and fiat currencies established as legal tender by the government. Having all of your savings in cash is a financial mistake, since the purchasing power only decreases over time. We would love to hear from you what challenges you face with this topic. If you like this kind of content, don't forget to like this video, subscribe to our channel and hit the notification bell button.